Picture this. You're 43 years old. It's a Tuesday night, the kids are finally in bed, and you do something you've been quietly avoiding for about 6 months. You log into your retirement account, you stare at the number, and then you just sit there. Because the number on your screen, the sum total of everything you've put away for the future after 2 decades of working, is roughly what a decent used Honda Accord costs. And the worst part isn't the number itself. The worst part is that you make good money. You always have. You've never been irresponsible. You don't have a shopping addiction. You don't blow money on stupid stuff. You just somehow got to your 40s doing everything you were supposed to do and ended up here, staring at a retirement balance that looks like a car payment and wondering where exactly the years went. And if that scenario made your stomach move even slightly, this video is for you. My name is Nick, and today we're going through every major money milestone you need to hit in your 40s. Not the vague feel-good kind, but the specific, uncomfortable, backed by actual math kind. Because your 40s are not a crisis, but they are a window, and windows, as it turns out, close. Before we get into the milestones, I want to introduce you to someone. His name is Dave. Dave is 43. He makes $95,000 a year, which puts him solidly above the median. He has a wife, 2 kids, one in middle school, one heading toward high school, a mortgage he can manage, 2 car payments he's less comfortable with, and $87,000 sitting in a 401k that he hasn't looked at since he enrolled. He's not broke, he's not reckless, he's just floating, doing okay-ish, which we're about to see is its own kind of problem. Milestone 1. Know where you actually stand and feel the weight of it. Let's start with the retirement savings benchmark, because nothing else in this video matters until you understand this one number. Fidelity, one of the largest retirement account managers in the country, says you should have 3 times your annual salary saved by age 40 and 6 times your salary saved by age 50. On Dave's $95,000 income, that's $285,000 by 40 and $570,000 by 50. Dave has $87,000. He is not a little behind. He is not rounding error behind. He is roughly $200,000 behind the 3 times benchmark. And if he does nothing different, he will be close to $500,000 behind the 6 times benchmark by the time he turns 50, 7 years from now, while he's busy not looking at his account. Now, before you feel too superior to Dave, the Federal Reserve's most recent data shows the median retirement account balance for Americans aged 35 to 44 is roughly $60,000 among those who even have accounts. For 45 to 54-year-olds, it's about $115,000. Against Fidelity's benchmarks, the average American is 3 to 4 times below where they're supposed to be. And 36% of non-retirees have 0 retirement savings at all, as in nothing. The account doesn't exist. So if you have something, even if it's not enough, you're already ahead of more than 1/3 of the country. That's not reassuring. That's just how bad the overall situation is. Here's why your 40s are the last real window and not just another decade to sort this out later. The compounding math stops being patient right around now. It's a 40-year-old who wants to reach $1 million by 65 needs to invest about $1,234 per month at a 7% average annual return. A 25-year-old needs just $381 per month for the same result. That's an $853 per month penalty every single month for being 15 years late. And within your 40s specifically, every single year you delay costs approximately $60,000 to $66,000 in lost future wealth per $1,000 per month you're investing, not over the course of your life. Per year of delay, think about what it actually looks like to ignore this. Dave hits 67, retires on $190,000 in savings, which at the standard 4% withdrawal rule generates about $7,600 per year in retirement income from savings. Social Security adds maybe $24,000 a year, so Dave's retirement income is roughly $31,600 per year. Average annual spending for retirees 65 and older is $61,432. Dave's retirement isn't a retirement, it's a math problem he can't solve. lived out one stressful month at a time in a house he's trying not to sell, wondering how a lifetime of work led here. That is not a scare tactic. That is the median trajectory for someone who waits until their 50s to take this seriously. The milestone: log in today, add up every retirement account you have, and compare it to 3 times your current salary. Whatever that gap is, write it down, because that number is now your project for this decade. Milestone 2. Kill the right debt in the right order. Here's something that will make Dave feel personally attacked. Elder millennials and the youngest Gen Xers on the Oregon Trail generation currently living in their 40s carry some of the most confusing debt loads in history. The average credit card balance for this age group is hovering around $9,100. That is the highest of any age bracket. But unlike previous generations, you guys have a unique roommate living in your bank account: student loans. Federal student debt is still hanging around for about 1 in 5 people in their 40s, averaging $42,000 to $45,000. And auto loans? Dave has 2 of them. The average auto debt for 40-somethings is now $28,500 per vehicle. Americans in this bracket are taking out more new auto loans than any other age group, often rolling negative equity from the last car into the new one. Add it all up: cards, cars, and diplomas from 20 years ago, and the average person in their 40s is carrying over $115,000 in non-mortgage debt. That is a staggering amount of money being redirected away from retirement accounts every single month. Money that could be compounding. Instead, it's servicing the past. So here is the hierarchy, because not all debt is equally urgent. First, credit card debt. This is an emergency, not a background inconvenience. If you're carrying $9,500 at 22% interest, there is no investment on earth that consistently beats that guaranteed return. Paying off a 22% credit card is a 22% guaranteed return. Index funds average around 8 to 10% historically. You cannot reliably beat 22% in the market. Trying to invest aggressively while carrying high-interest credit card debt is like filling a bucket with a hole in the bottom and wondering why it's not full yet. Second, car loans, and this needs its own conversation. And Dave's 2 car payments are probably somewhere around $1,400 per month combined, which is $16,800 per year flowing into assets that lose value every single day he drives them. If Dave invested that $1,400 per month instead at 8% annual returns, he'd have roughly $1.09 million over 30 years. His 2 trucks will collectively be worth about $11,000 in 10 years. The math on car payments in your 40s is genuinely brutal, and most people don't run it because they don't want to know. Third, student loans. If you're still carrying them in your 40s, put an actual end date on the calendar. Not a vague intention, a date. Circle it. The psychological weight of an open-ended debt you've been dragging behind you for 15 years is its own tax on decision-making. The mortgage gets its own section later because it's more complicated. But consumer debt, credit cards, cars, student loans, needs to be systematically eliminated in your 40s, not managed indefinitely. Milestone 3. The thing 76% of you haven't done okay. We need to talk about something that has nothing to do with investment returns or savings rates, and yet might be the most financially consequential thing in this entire video. Only 24% of Americans currently have a will. The 35 to 54 age bracket, which is you and Dave, is the single largest group of people with no estate planning documents whatsoever. Worse than 18-year-olds. The generation with mortgages, minor children, retirement accounts, and life insurance has done less estate planning than people who are legally allowed to vote for the first time. Make that make sense. Here's what happens when Dave doesn't have a will and something goes wrong. His assets go to probate, a court-supervised legal process for distributing property that has no idea what Dave wanted, doesn't care what Dave's wife assumed, and will take between 6 months and 2 years to resolve, while charging somewhere between $15,000 and $40,000 in legal fees along the way. The decision of who raises Dave's kids left entirely to a judge who has never met them, not a trusted family member Dave designated. A court. Only 36% of parents with minor children have a will. That means nearly 2/3 of parents with kids at home have outsourced the most important decision of their lives to the state's intestacy laws: a basic estate plan, a will, a durable power of attorney, a healthcare directive. Costs between $1,000 and $2,500 with an attorney one time. You'll spend more time this year researching a new TV than it takes to get this done. Now, here is the piece of estate planning that almost no one tells you about, and it's the one that creates the most quiet disasters. Your retirement accounts, your 401k, your IRA, your life insurance, these assets pass directly to whoever is named on the beneficiary designation form. They completely bypass your will, which means if Dave got divorced in his 30s, updated his will, but forgot to change the beneficiary on his 401k, his ex-wife gets his retirement account. His current wife gets nothing from that account. His will is irrelevant. And this happens constantly. Every account, every policy. Check the beneficiary designations this week. Milestone 4, life insurance. The math that should make you move today. About half of Americans in their 40s have no life insurance at all. Among those who do, roughly half are underinsured. The standard financial planning recommendation is 10 to 12 times your annual income in coverage. On Dave's $95,000 salary, that's between $950,000 and $1.14 million. Dave's employer provides life insurance equal to 1 times his salary, $95,000, which covers his family for approximately 18 months before the money runs out and his wife is managing a mortgage, 2 kids, and everything else on a single income. That's not a safety net. That's a slightly softer landing before the same fall. Here is the one number that should make you act on this today rather than later. A $500,000 20-year term policy for a healthy 40-year-old male costs approximately $35 to $67 per month. That same policy for a 50-year-old costs 2 to 3 times more. Life insurance premiums increase roughly 8 to 10% for every year you wait past 40. And if your health changes before you get around to it, a diagnosis, a new medication, a flag on your blood work, your premiums go up significantly or you get declined entirely. The window for cheap, easy life insurance is open right now. It will not stay open indefinitely. Get a 20-year term policy that covers 10 to 12 times your income. Not whole life, not universal life. Not whatever a commission-earning insurance salesperson is excited to explain to you over a 2-hour lunch. Term insurance is clean, cheap, and does exactly one thing. It pays your family if you die before the policy expires. That is the product. Any policy that also builds cash value or acts like an investment is a policy that's primarily building value for the person selling it. Milestone 5. The college versus retirement trap, and the one rule that settles it. This is the section where some of you are going to feel a little defensive. That's okay. The math doesn't care about feelings, and neither does retirement. If you have kids heading toward college, you're feeling real pressure to save for their tuition. Dave's daughter is 14. He's been lying awake thinking about it. 4 years at a state school will run somewhere around $120,000 to $140,000 by the time she gets there. Dave doesn't have that. Because Dave is a good dad, he's quietly considering pausing his 401k contributions for a few years to build up a college fund, maybe even pulling from his retirement account to cover the gap. Here is the one rule that overrides every other instinct on this topic. Retirement savings come before college savings every time, without exception. Not because your kid's education doesn't matter, because you cannot take out a loan for retirement. There is no financial product called a retirement loan, no government program that gives you money at 72 because you prioritize your kid's tuition over your own financial security. What there is a very real scenario where Dave runs out of money at 74 and becomes financially dependent on the daughter whose college he sacrificed everything to fund. That is not a gift to her. That is a burden with good intentions attached. About 62% of parents plan to delay retirement to pay for their kids' college. Pausing contributions for just 2 years in your 40s can cost over $100,000 in lost compounding by retirement. And withdrawing from a 401k early triggers a 10% penalty plus income taxes. Dave could lose 30 to 40 cents of every dollar before his daughter registers for a single class. Here's the counterintuitive part that nobody mentions. 75% of undergraduates receive financial aid. College sticker prices are not what most families actually pay. And the Secure 2.0 law now allows up to $35,000 in unused 529 plan funds to roll directly into a Roth IRA. So even if you oversave for education, there's an exit ramp. There has never been and will never be an exit ramp for undersaving for retirement. Fund retirement first, fully. Then direct any genuine surplus toward a 529. In that order, always. Milestone 6, the mortgage question, and why the answer isn't what you think. A lot of people in their 40s feel a deep, almost emotional pull toward paying off the mortgage early. The idea of owning your home outright, no payment, no bank, no lien, is genuinely appealing, and sometimes the math supports it. But here's the situation for a massive chunk of homeowners right now. Over 60% of American homeowners locked in mortgage rates below 4% during the pandemic. If that's you, aggressively paying down that mortgage might be one of the more expensive mistakes you can make. Here's why. $100,000 invested in a broad index fund at a historical 8% annual return grows to approximately $1.74 million over 30 years. In that same $100,000 used to pay off a 4% mortgage saves you about $66,000 in interest over the life of the loan. The difference between those two choices is over $1.67 million. You are paying a $1.67 million premium for the psychological comfort of not having a mortgage, while your money sits locked inside walls you can't spend. And that's the other thing about home equity that doesn't get said enough. Equity is illiquid. $200,000 in home equity means $0 available in an emergency, unless you take out a loan against it or sell the house. It feels like wealth. It doesn't function like wealth when you need it. Milestone 7. Max the limits and plan for the catch-up before it arrives. For 2025, the 401k contribution limit is $23,500 if you're under 50. The average American contributes roughly a third of that. But here's the mechanism you need to know about: the catch-up. When you turn 50, the IRS allows you to contribute an extra $7,500, bringing your total allowed annual contribution to $31,000. If you max that catch-up provision from age 50 to 65, just that extra bucket, at a 7% annual return, that generates roughly $730,000 in your account by the time you clock out for the last time. That is not a rounding error. That is a lake house. But here's the trap Dave is about to fall into. He tells himself he'll start maximizing contributions when he turns 50. He has a plan. And then 50 arrives and his daughter's in college, his parents need some help. The kitchen hasn't been updated since 2009, and the $7,500 catch-up contribution evaporates before it's ever made. Good intentions consumed by real life. Build the plan for the catch-up now, before 50 arrives. If you can't max your 401k today, increase your contribution rate by 1% right now, and schedule another 1% increase 6 months from now. Make it automatic. Remove the decision from your monthly willpower budget entirely. The people who successfully hit the catch-up don't find discipline every month. They remove the need for discipline by automating it. Milestone 8, check your allocation. You might be losing to yourself last one, and it's quieter than the others, which is exactly why it does so much damage unnoticed. A lot of people in their 40s set their 401k investment allocation once, maybe when they first enrolled in their 20s, and never touched it again. If you're in that group, there's a reasonable chance your portfolio is too conservative for where you actually are in life. The old guideline, 100 minus your age in stocks, would put a 40-year-old at 60% stocks and 40% bonds. But a 40-year-old retiring at 65 has 25 years of compounding runway remaining. At 2.5% annual inflation, your purchasing power erodes 46% over 25 years. A 40% bond allocation at 40 years old often can't outrun that inflation drag. Modern financial advisors have largely moved to 110 or 120 minus your age, putting a 40-year-old at 70 to 80% equities. Log into your 401k today. Look at your current allocation. If you haven't touched it since you were 27, there's a very real possibility you've been quietly throttling your own returns for over a decade while thinking you were being responsible. I want to leave you with two versions of Dave. The first Dave is the one we've been following. He didn't look at his account until 43. He kept the car payments. He never got the will done, kept meaning to. He paused his 401k contributions for 3 years to help with college. He made extra mortgage payments on the 3.2% rate he'd locked in during 2021 because it felt like the responsible thing. He meant to bump his contributions when he turned 50, but life got in the way. He's 67 now, and his retirement income is about $29,000 a year. He didn't do anything wrong exactly. He just never did the right things specifically enough, at the right time, consistently enough. And now he has a house, 2 adult kids he loves, a lifetime of good memories, and a financial situation that terrifies him every single month. The second Dave made different choices, like same income, same family, same life, roughly, but he ran the numbers at 43 when it was uncomfortable instead of 63 when it was too late. He killed the credit card debt. He got a term life policy before his cholesterol became a problem. He spent an afternoon getting his estate plan done. He kept funding his retirement even when his daughter went to college, and he found ways to help her that didn't require robbing his future. He maxed the catch-up at 50 because he had automated it before 50 arrived. He's 67 now, with $880,000 in retirement accounts, a paid-off home, and the thing that money at its best actually buys: options. The option to retire when he wants, the option to help his kids without panic, the option to not check his bank balance before saying yes to something. Same decade, completely different outcome. The difference between those two Daves isn't talent, luck, or income. It's a series of specific decisions made in a specific window that either happened or didn't. That window is your 40s. It is open right now. None of these milestones are exciting. None of them will make a good Instagram post. You're not going to go viral for checking your beneficiary designations or bumping your 401k contribution by 1%. But in 25 years, when the second version of you is sitting across from the first version, the one who meant to but didn't, you'll know exactly which decisions made the difference. Make them now. While the math still gives you a fighting chance,